My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College, and in this video we are going to discuss loss contingencies. So loss contingencies occur when there is some uncertainty with regard to events that might occur in the future. A lot of times loss contingencies are related to things like litigation, lawsuits, and other legal proceedings. So for example, we might be the defendant in a product liability lawsuit, or we might be the defendant in a patent infringement lawsuit, or the EPA may be investigating us for possible violations of Clean Air Act or something like that. And so something has occurred. The plaintiff has filed a lawsuit against us, or the EPA has given us official notification of an investigation of some sort. And so that event triggers not necessarily the recognition of a loss, but we're sort of put on notice that something significant is potentially going to happen. And whether a loss is actually incurred or not in the future is a function of some future event. So for example, in the case of a lawsuit, patent infringement lawsuit for example, then eventually that lawsuit will either be negotiated or we will actually go to court and have to deal with the situation there. At some point though, that will be resolved, and we will then be able to determine with certainty whether we have a loss or not. In the intervening period of time, there is some uncertainty with respect to whether a loss is going to be incurred or not. And that's what a loss contingency is all about. It is the recognition that some significant event has occurred in which a loss is potentially going to happen at some point in the future, but there is some degree of uncertainty surrounding that. So the question then is, how do we go about accounting for loss contingencies? And we are first going to look at US GAAP, and then we will look at International Financial Reporting Standards, because there are some significant differences between US GAAP and IFRS on this particular issue. Alright, so we've defined what loss contingencies are. Those involve existing uncertainties as to whether a loss actually exists, and that uncertainty will only be resolved when some future event occurs. Now, the initial recognition of a loss contingency, whether we have to recognize a loss or not, or the extent to which we need to disclose these circumstances to the shareholders, is a function of two things. One is the likelihood of that future event occurring, of the loss actually being generated. The second dimension is our ability to put a reasonable estimate on the dollar amount of the loss. So in this little table here, I have the likelihood of the event occurring on the rows, and our ability to estimate the loss in the columns here. So we're going to take a look at this from the bottom up actually. So at the bottom, in terms of likelihood, is a remote likelihood or a remote possibility that we will lose the lawsuit, or that the EPA will find us in violation of that Clean Air Act or something like that. That is an assessment by management and possibly their attorneys. If we determine that the likelihood of the loss occurring is remote, yes, somebody's filed a lawsuit against us, but we think we can win this pretty easily, it's a nuisance lawsuit, then we don't even have to disclose that that exists. So if management determines that there is a remote possibility, then there's no disclosure that's necessary. If management determines that there's a reasonable possibility that we will lose this lawsuit or will be found in violation of the EPA standards or whatever the situation is. If we determine that it is reasonably possible, then we are required to disclose those facts in a note. So we talk about not only the financial statements, balance sheet and income statement and so on, but the footnotes to the financial statements. And that's what this is referring to, a disclosure note. So we would have to tell the shareholders that we are subject to a lawsuit. There is a possibility that we'll lose the lawsuit, but an equal possibility that we can win the lawsuit and therefore not incur any loss. At that point, we just simply need to provide a disclosure note describing those facts and circumstances. Where we have to recognize, actually record a loss and an associated liability is when management concludes that the likelihood of the loss is probable. So if we determine that it is probable and we can reasonably estimate the dollar amount involved, then we have to accrue the liability and disclose this in the footnotes. Now, the reason why I have disclosure note crossed out over here is because it is very, very rare, almost never happens, where management can conclude that the likelihood of the loss is probable, yes, we're going to lose the lawsuit, and simultaneously we have no idea what the dollar amount involved is. There might be a wide range of estimates of the loss, but it's very rare for us to conclude that there's a probable loss, but we don't know what the dollar amount is. That just doesn't happen. So typically, if we are coming to the conclusion that we're going to lose the lawsuit and we will also be able to have some reasonable, at least some reasonable estimate of the dollar amount. In that case, then, we need to accrue the liability and recognize the loss on the income statement and also discuss the facts and circumstances in a disclosure note. Now, a lot of times, especially if we're in this reasonable estimate category here, we may have a range of estimates. So our attorneys say, you know what, we're being sued for patent infringement. Yeah, we're probably going to lose this, but maybe we can negotiate it down, and we think the loss will be between X and Y. And X and Y are $1 million to $2 million or something like that. The first step is, it is probable, and we have at least a reasonable estimate, which means we need to recognize the loss. Now the next step is to determine how much, the dollar amount of the loss that needs to be recognized. And what US GAAP says is that when there is a range of estimates, it is actually the smallest amount. Firms are permitted to use the smallest amount within that range to determine the value of the contingency. So if the lawyers say, we think we can settle this out of court for somewhere between $1 million and $2 million, then we can record a loss for $1 million, or we would accrue a loss and an obligation of $1 million. Even if it subsequently turns out to be $2 million, what we need to do today with these known facts is to record the loss at $1 million. The International Accounting Standards, IFRS, has some differences between there are some differences between IFRS standards on this issue and US GAAP differences. First thing is IFRS uses a more likely than not standard for recognizing, while US GAAP uses the probable standard. More likely than not is a lower threshold for recognition. In other words, losses are more likely to be recognized if we are following IFRS standards versus US GAAP standards. So where management may talk about the likelihood, is it probable, that's a management, there's some judgment that needs to be involved in there. Is 70% probable? Is 75% probable? Is 80% probable? At what point do we get, yeah, we're probably going to have a loss? More likely than not is generally interpreted as simply being a greater than 50% chance. So 51% chance would meet the standard of more likely than not, but might not meet the probable standard. And that's what we mean by a lower threshold for recognition. IFRS also requires the use of expected value for measurement of loss rather than the minimum estimate within a range. What that means is that the contingencies, when we are applying IFRS, are likely to be larger dollar amounts being recorded. So in that earlier example where I had the lawyers telling us that the loss was going to be somewhere between $1 million and $2 million, US GAAP, we're allowed to use the minimum amount, which would be $1 million in the range, but IFRS, by and large, would probably require us to record at least a $1.5 million, the midpoint of the range. That's going to be more like the expected value. Now, expected value is really a statistical, mathematical process. We're not going to get into the details here, but just understand that applying IFRS will generally result in greater values being recognized for contingencies. The last significant difference between IFRS and US GAAP is that IFRS requires the use of present value to record the loss contingency, while US GAAP permits but does not require the use of present value. That really only is going to have an effect when the loss is expected to be settled more than 1 year from the balance sheet date. That's really when present value computations come into play, and we're going to sort of bypass that particular issue right now. All right, so now let's take a look at an example. So we have a company that's a defendant in a patent infringement lawsuit. Their attorney has concluded the company has about a 60% probability of losing the lawsuit. And if the lawsuit is lost, they think the damages will be somewhere between $150,000 and $300,000. Well, under US GAAP, the first thing that we have to do is assess the likelihood of the loss. Is it probable, reasonably possible, or remote? We'd have a hard time arguing that it's remote. 60% is pretty substantial. It's not 5 or 10% chance. It's more than remote. But management could reasonably conclude that it is not probable. It's reasonably possible. It's not much more than 50% likelihood of losing the lawsuit. So management could conclude that the loss is only reasonably possible, and therefore we only need to disclose the facts and circumstances in the footnotes. There is no loss to be recorded on the income statement and no liability to be recorded on the balance sheet. Under IFRS, however, we would have to conclude that the lawsuit is more likely than not to occur. Greater than 50% chance is more likely than not, and that means that we would have to record a loss this year and record the associated liability. The second step then is the dollar amount. IFRS requires this expected value thing, and so the range is $150,000 to $300,000 with equal chance of any amount within that range being realized. So the attorneys have come to the conclusion we've got a 60% chance of losing this thing or settling, and we think we'll end up somewhere between $150,000 and $300,000, but any amount in that range that's where the uncertainty is, and that's why this is a contingency. And so expected value would simply take the midpoint of between $150,000 and $300,000, which would be a $225,000 loss to be recognized. Now, that's what happens in this particular situation. Let's change it up a little bit and say we've got same company, patent infringement lawsuit. However, notice that the probability of loss now is 90% of losing the lawsuit. And so the range is still the same, etc. At this point, we would probably have to conclude that it is a probable loss. 90% chance of losing this thing is pretty substantial. However, notice or remember that according to US GAAP, the minimum amount in the range can be used to record the loss. So under US GAAP, we would recognize a loss with a debit to a loss account and a credit to a liability account, but we'd only recognize $150,000. That's the minimum within the range. IFRS is unaffected by the change in the circumstances here. It's still greater than the 50% chance of losing the lawsuit, and the range of estimates here is still the same, and so we'd still recognize a $225,000 loss under IFRS. So that's what I was talking about earlier back here, where the threshold for recognition for recognizing the loss contingency under IFRS, it's a lower threshold. In other words, losses are more likely to be recognized if we're applying IFRS. And second, this expected value concept will generally result in greater losses or higher dollar values of losses being recognized. And so that's a significant difference between US GAAP and international accounting standards. As you can imagine, management of companies would prefer the US GAAP standards as compared to the IFRS standards. Management of firms don't want to have to recognize or disclose losses and contingencies and liabilities. That has a negative effect on the income statement. Recording a loss reduces income that's reported. Recording a liability increases the debt-to-asset ratio. So it does not help the firm. It hurts the firm from a financial performance and financial status standpoint. So management of companies would much prefer the U.S. rules as compared to the IFRS rules on this particular issue. And so that's an overview of US GAAP and IFRS standards with respect to loss contingencies.